folks, hope everyone's well and welcome to the first of the technical education videos that I mentioned I had in mind during the channel intro video. We're going to have a look at market structure to start, certainly my implementation of market structure. And I decided to start here just based on some conversations I've been having in Discord and in response to an article that I wrote recently around the structure of Dixie. It made sense to go over that in a video because it's one of those topics that is quite hard to convey in writing, so that article might have been a bit difficult to follow, but when we've got the video we can jump into the charts and have a look at it. My intention is to run this as a series of videos to try and keep it as short as possible, so I'm going to split this into 5 volumes. The first of these, and the one that we'll cover today, is an intro to market structure and looking specifically on a single time frame. The next videos will look at multi-time frame analysis, the structural relationships between the time frames, trading ranges, order flow and other points of interest that I use to define narrative and bias at the different levels. And then we'll conclude with a video just pulling that all together to show how I use it to define that narrative for trading and position. So the goals for today's session then is to come away with an understanding of market structure and its importance, or my implementation of market structure and its importance. The study of a single time frame and the market structure within that single time frame. Be able to identify within that time frame the major and minor swing highs and swing lows. A general understanding of what makes a major swing high and a major swing low, and why the majors and minors are important within the structure. The importance of that structure from both a continuation perspective and when it shifts in terms of framing that bias that I spoke about earlier. And we'll have a look at some examples of how that application on a single time frame might have told us some stories in previous market examples as to where the market was headed. First thing to look at here then is a general schematic of a single time frame structure. So this schematic on the screen shows both bullish and bearish order flow, so bullish on the left hand side, bearish on the right hand side. And generally we just look at that in terms of trend and trend continuation, so higher highs, higher lows, higher highs, higher lows. And then the bearish is the opposite of that, so lower lows, lower highs, lower lows, lower highs. This schematic just shows the major swing points. You don't see any minor swing points on this because it's just something that I've drawn, and in reality the price charts are never ever this clean in terms of the major structure. You'll generally always look at a chart and there'll be many highs and lows in between what I would define as being the major highs and lows. It'll become more obvious when we look at it in a chart in a minute, but the main point to take away, and something that beginners especially find it difficult to work with when I'm talking through market structure and how I see market structure, is that not all highs and lows are created equally. Some are major for the time frame that you're looking at, and some are minor. The ones I care about overall on each time frame are the majors for that time frame, as they signify the key structural points for order flow, and where liquidity might be on continuation or in a reversal scenario. The minor structural points, just as a note, those are more often than not the major structure on the next time frame down, depending on the time frames you use. And we'll look at that more when we're talking through the multi-time frame analysis videos. In terms of those time frames, I use monthly, weekly, daily, 4 hour, 1 hour, 15 minute as my general kind of go-to time frames. But there are obviously other time frames available, and you have to work at what ones you want to use within your process. But in general, this shows a high level schematic of market structure, including a reversal in the middle there, and how reversals can generally look in terms of that structure, where the structure breaks, where the retrace goes back to, and then where the low breaks again in terms of that 3-point reversal. If we look at this then in a chart, and this is the Dixie Dollar Currency Index daily chart, and the daily chart is my general go-to where I start my analysis on structure, mainly because I spend most of my time in the 4 hour, 1 hour and 15 minute from an intraday perspective, and the daily chart gives good bias in terms of the structure and where the price might be headed on a daily level. which defines the direction that I want to be looking for within the time frames below. But we'll cover that when we look at the multi-time frame analysis. So as you can see just from this snippet that's on the screen here of the Dixie chart, it's never quite as clean in terms of structure as the line chart or the schematic that I put on that previous slide. But if we start to have a look at how I would put this together and how I would analyse this chart, on the left hand side here we can see we've got a high and then a low, and then this high is broken. So we can see this high is broken here. Now for me, a high break is candle body close. I don't consider a wick to be a structural break, particularly on the major structure. Oftentimes a wick above a key level and then a fast snap back into the trading range is a liquidity grab. It's just the market taking the liquidity in terms of stops that are above or below that major structural point. So in order for me to define it as a major high or low structure break, it needs to be a candle body close. So we can see there clearly was a candle body close above this high here, making this here the new structural high. So this is a bullish break above a previous high, so we'd be looking for this now to potentially set higher lows and then continue to the upside. But until we see the second higher low and break, we would remain neutral in terms of that direction. But ultimately this becomes a trading range if I throw a fib on there to highlight that for you. I'll do it the other way around so I get the right idea. So that there becomes a trading range on the daily, and what I'm looking for in terms of structure and where we're going next is the extremes of that range to then break. So if we're going to continue to the upside, we'll see a range high break after a retracement into a reasonable area of the range. So generally I look for either the 0.5 or below if it's a bullish break, or the 0.5 or above if we're looking at bearish structure. But in this scenario we can see the break actually comes to the downside, so this here is the first break of that trading range. That confirms this as range high and major high, and it confirms this low here when it sets this low, because that's the one that has the first reasonable pullback, as a new major low. It breaks this trading range and puts us into a new trading range, and that new trading range is the major high to the major low. So that becomes our new trading range. Now in this scenario we don't actually get any sort of reasonable pullback into that. It's a very small pullback to this level here, and then this low falls again, making this a major structural low. So as you can see, there's a lot of highs and lows in between all of this stuff here. These minors here, these minors here, these are all kind of minor structure. So again, we'll look at this when we look at the multi-time frame analysis, but you'll probably find that those are major structure on the H4 at that level. But from a daily perspective, they're minor highs and lows, or the way I see them as minor highs and lows. So what I'm looking for again now, we've got this range. This is our trading range here. So we're looking for where does that range break, and it takes a fair while for that. So to me, I would view that entire period of months there as just trading within that range. It's just bouncing around within that range. There's no break below, no break above, until this point here. And as soon as that happens, this becomes the high. When that is set, I'll take that range out. Just mark that in there so you can see it. So that's the break. Now this was in bearish posture, so low, high, lower low, lower high, lower low. This then becomes a structural break above that level. So now we're into neutral. We're looking for a high to be set, a higher low to be set, and then this high to be taken out, and that I would deem to be a confirmed reversal at that point in time. So as soon as we see this low here set, and then this high close above that high, that is essentially a reversal. So from this point, I'd be looking for a pullback into the new trading range, which is now here. So you can see it's a far tighter trading range. And again, I'll put that the right way around. So you'll be looking for a pullback into discount of that range, so below the 0.5 essentially, and then continuation to break the range high. And that's exactly what it does. Pulls back in, breaks the range high, and then you again at that point mark out your range. So this becomes your low and this becomes your high, and you'd be looking for a pullback and then a break of that high, which is what we see here. So this is the low, and then it breaks that high to here, low, breaks the high, and then we see a potential shift again here where this low is broken. So we're in bullish posture here. This is bullish order flow, and then this low is broken, and at that point again I would return to neutral in terms of how I view where we are in the market, and I'd be looking to see what happens next. Now in this scenario it continues again, so we see again the high is broken by close, we get a pullback, the high is broken, and we continue on. But we would have paused at this point. You wouldn't, or certainly I wouldn't have jumped in straight away and said that's a structure break, we're going to see a bearish breakdown here. I would be looking for what happens next. Do we get either a break of this low or a break of that high? And that's the confirmation of where we're going from that perspective. So to save drawing all that out, I'll take these off and I will put on here's some stuff I prepared earlier. So this is my actual chart for daily, for the daily Dixie at this point in time, in terms of the structure. So you can see there's an awful lot of highs and lows within that, and an awful lot of interim or intermediate highs and lows within, but it's only the major structure that I'm interested in from a daily perspective. Is it continuing to break highs? Is it continuing to pull back into the range? Is it continuing to break the high and pull back into the range? Because that, if it's going to continue with that pattern, sets me with a narrative that we're going to see continuation on. If the daily pulls back into a reasonable point of interest within the discount of that range, then the general idea is that it's going to continue and we can target range high as a minimum for a break. And oftentimes, even if we're not going to go on beyond range high in terms of continuation, even if all we do is wick through it, if we know when we're approaching range high and we're in trades that we're taking our profits on a long at that high, even if it's going to be a liquidity grab, it gives us a pool of liquidity to get out on. And then in the retrace, if it looks like the retrace is going to a reasonable point of interest within the range and it's going to continue, we can potentially jump in again, but it just gives us nice areas to A, take risk off for the trades, and B, target for profit to get out the trades. So that's the Dixie on a single time frame analysis in terms of how you take some of the noise out of it, not be looking at every single high and low as support and resistance or somewhere where you're going to see reversal, you're going to see continuation, and just looking at what are the key highs and lows within it, the major highs and lows, where are the structural shifts within those major highs and lows, and what do you want to do in terms of forming a bias or a narrative around that. To try and tie all of that together, just a couple of things worth mentioning. So I've said point of interest a few times there, and when I say point of interest, what I mean is the areas within the chart that you could reasonably expect either a retracement to react from, or an impulsive move that's breaking structure to react from. And generally I take those from the time frame that I'm looking at +1. So in this instance we're looking at the daily, and if we're looking for somewhere where the daily breaks structure to the upside, so it's an impulsive move through a range high, I would be looking on the weekly to see if there are any points of interest within the weekly time frame where that impulsive move might react, might stall, as well as on the time frame itself. Is there anything on the daily that might be an area of interest that move might stall? Now for me that is gaps, be that the fair value gap or general price gaps in a CME chart, liquidity voids or order blocks, breaker blocks, or fib levels, and generally I'm looking for 618 to 786 retracements, and 1.618 impulsive moves. So those would be the kind of points of interest I'd be looking at, but there are many different points of interest you could take. Those are just the ones that I tend to use. And in terms of trying to put some words around the structural breaks, this sounds a lot more complicated than it is, but it's essentially the rules that I have written down. So the major swing high is created at the highest point that led to the break of the previous major swing low by a candle body close, and a new major swing low is created at the lowest point within a time frame breaker structure inside that time frame point of 1 plus 1 point of interest. So again, that's for bearish order flow. It sounds really complicated, but it's just what we've gone over a second ago in terms of you've got your major low set. If it's going to be bearish order flow, you see that major low broken by candle close. The highest point between the previous low and the break is your new major swing high, and the lowest point before it starts to pull back is your major swing low, and the reverse in a bullish scenario, obviously. So these are just on here to kind of try and put some words around it and make it make sense a little bit. And to go over that just in another example, just to try and paint another picture of it, I'm not going to go through the process of mapping out all the major highs and major lows in this one. It's just a really good example. So the Dixie there was a reversal at the bottom, a change in structure, a shift in structure at the bottom with follow through into a really, really bullish posture. I think we all know the Dixie's very, very bullish at the moment. So this example is from Bitcoin on the daily. And if we look back as far as the low in November 2020 here and the highs around about the same time, and map the major structure using the same rules all the way through, what's interesting in this one is that the break of structure followed by the failure swing and then the second break of structure on both occasions in the previous bull market for Bitcoin called the relative tops. So we see here, we see the highs, lows, highs, lows, highs, lows, and this major low here, when this was broken, should have been the first warning based on the schematic that we looked at previously, that structure was shifting from that bullish posture, from bullish order flow, potentially towards the bearish order flow side. The second point in the 3-point reversal that was spoken about was this failure swing here, this lower high, and then confirmation here as soon as this candle here closed below that low. That was confirmation that we had seen a reversal there and we were likely to go lower. Not definitely going to go lower, but it was more likely at that point that we were going to go lower than high. And as we can see, it came back and retested a previous trading range, which is quite normal for charts. You do tend to find previous trading range highs and previous trading range lows are key areas to watch out for in terms of points of interest that we spoke about a second ago for those reactions. Now, interestingly, the size of the range set at that point from here to here meant that all of this in here was neutral. Given that the structure break had happened, the bias on this time frame would have been a retrace into in a reasonable kind of premium of the range, and then continuation again to the downside. But what we actually saw was a range break again above the high, setting this high here, set a higher low and then another higher high, but then it broke again and we saw the same thing happen. So low break, failure swing, low break, and that there again would have given you kind of a reasonable confirmation that we were looking to go back to the downside. It's happened twice now in terms of a shift within a short space of time, and it would have given you the opportunity potentially to either exit positions or enter short positions around the kind of 52,000 range on Bitcoin within that. Now this is just individual single structural analysis on a single time frame. It's a little bit more nuanced when we start looking at the multi-time frame structure analysis. For example, within this, here, that is quite clearly to me, just looking at it here on the daily chart, a structure shift on the 4-hour time frame that's now bullish posture. So within that, on the intraday levels, I would have been bullish on the short-term time frames, the intraday trades, while it was in that in that posture. Daily order flow bearish and H4 order flow bullish generally means that the daily is taking a retrace. So it's more nuanced than just saying you're not going to trade on the daily chart and the daily chart is everything you're looking for. For me, the daily chart is the starting point, and then I'm refining that down through the time frames with the fractal nature of price. But I thought this was a good example to look at in terms of how, even on the daily chart, just mapping out the major structural levels, using the rules that we've spoken about before, and taking out all of the interim or the lower time frame minor structural points would have taken away all the noise from this daily chart and given you a good estimation of where things were going just based on that daily structure. You would have had the right bias on that daily structure, and as you can see, we're still very much in bearish territory for Bitcoin. And if you look at the pullback here within the current trading range, so the current range is here to here, we actually got above that 50% level. I'll just map it out so you can see it all the way across. We got above that 50% level, and when I spoke about points of interest, we ran back into this daily liquidity gap. So the odds at this point in time, seeing the 4 hour then shift bearish, would be that we are likely to break the low again. It's not certainty, it's not a prediction, it's just, as I say, this is what provides me my narrative. So I'm looking for shorts at this point in time. If the lower time frame structures then start to flip the other way, then I would flip that bias. Bias is not permanent, it's just what gives you your narrative at any given time. But for the moment, just looking at this from a daily perspective, the odds are that the higher probability is a break to the downside until proven otherwise. So I say that's another reasonable example of single time frame structure and how filtering out the noise of the interim highs and lows and just concentrating on the major structural points and the breaks of the major structural points can help you form your bias in terms of the direction that you want to take trades in, or your expectations for lower time frames. And we'll look in the next session at tying that together with the lower time frames and looking at how they interact with each other, and how you use two or more to form a bias from a trading perspective. In conclusion then, just to wrap this one up, I've stuck a couple of kind of key points from this on the screen that we'll take through into the future sessions in the series. So first up is major and minor structure exists on all time frames, and hopefully now you've got a better understanding of what that major and minor structure looks like. The major structure on the time frame that you're looking at is key for identifying the trading ranges on that time frame, and filtering out the minor structure removes a lot of the noise, highlighting the key areas to focus on within that time frame. Identifying the trading ranges this way between the major swing points allows for better identification of the points of interest on that time frame, which you would then look to use on the lower time frames for reaction within that major structure, which is something we'll go on to look at in the rest of this series. Structure breaks and then follow through of that structure break on the higher time frames set you in good stead for that reversal bias, and the higher time frame always takes precedent. If you're looking at a 1 hour chart or a 4 hour chart, but the daily chart is saying something different, then you would give more weight to the daily chart, and similarly if it was the weekly chart or the monthly chart, the higher time frame charts are the ones that always take precedent in terms of price movement, or certainly the way that I look at it, they always take precedent in terms of the price movement. And similarly, the continuation breaks on higher time frame set a continuation bias for the lower time frame chart. So if your daily chart is bullish and it breaks the high and pulls back into the range, hits a point of interest on the weekly chart, and the 4 hour then reverses within that point of interest either on daily or weekly, then there's a fair bet that the retrace that the daily has just taken is complete, and the H4 now is going to return to bullish posture until the daily high is broken. So that would be your bias for continuation. And mapping this out on multiple time frames, like I've just kind of explained at a high level there between the daily and the H4, and understanding the relationships between price and the fractal nature of it within those time frames is a really powerful tool for providing your narrative, be that for swing trading or intraday trading. So we'll cover that off in the next session. But that's it. Hopefully that wasn't too long and it made sense. Any questions, let me know in the comments. But for now, stay safe. My tea's it. Gotta go.